everybody, it's Chris Kirkpatrick with Life 180, and in all the videos that I've done on YouTube, I get a lot of responses, a lot of passionate responses, a lot of positive, some negative, a lot of negative, I suppose, but a lot of questions ultimately around life insurance and what is the properly structured whole life policy. You know, you hear me talk in a lot of my videos about whole life insurance is one of the best financial vehicles and tools that you can use as long as it's structured properly. And so at this point in time, over the last couple of years, I've had enough questions and comments and requests to say, hey, Chris, what exactly does that mean? I think that's probably the most common question that I've ever come across. So what I wanted to do is I wanted to introduce Caleb Guilliams. He is the CEO of Better Wealth Solutions. We've done a lot of work together. He's actually my personal agent. And you know, he's just a wealth of knowledge. He's literally one of the few people in the industry that I trust to actually do it right, because his heart, his head, his mind, his intellect, everything's in the right place. And what we're going to do is we're going to go through the 4 different ways that you can structure a whole life policy, just to give you education to make sure that you don't get taken advantage of if you're talking to somebody. If you do want to talk to somebody that you know you can trust, you know, hey, we can circle back and we can help you out. But ultimately, we're going to go through each step, you know, the traditional policies that people like Dave Ramsey and Suze Orman and the like, you know, anybody in that kind of atmosphere like to bash on whole life. Well, you're going to see why we'll actually kind of agree with them, that they're right. Doing it in the way that they typically structure whole life policies it's really not effective. It's not necessarily as bad as they want to make it seem, but it's definitely not everything that we tell you it can be, right? And are going to show you that it can be. And so then ultimately we're going to go through 3 different other options of properly structured policies based on what it is that you're looking to accomplish. And I'm going to let Caleb talk a lot about that, and I'll interject as we go here. But so I've introduced you a little bit here, Caleb. And so if you want, I'd love for you to just say a couple words about kind of what you do, what your background is, talk about your book a little bit if you could, and then we'll get into this thing.
Thank you so much, Chris. You know, I remember when I first got into this business, I was hungry to want to learn more, and your videos were amazing. And that's kind of how we got connected. And it's just fun to be on here and to be kind of jamming. But to give you a little bit of information about myself, like you said, my name is Caleb. I'm the founder and CEO of a company called Better Wealth Solutions. We specialize in what I'm going to share with you today, and we're really, really passionate about it. But I'll tell you that passion has come from a big madness or just like this sense of like feeling like I've been lied to. And as you know, Chris, in the industry, we do not know what we're doing. That's why I wrote the book, The And Asset, The Secret Way to Save and Use Your Money at the Same Time. Essentially, the summary of the And Asset is we are our greatest asset. We need to understand how efficiency affects our life. We have to understand that the value of our dollar compounded the rest of our life is incredible. But the most important part as it relates to wealth, especially if you're a high achiever, is understanding how to control your money. And so it's one thing to get the philosophy, but one of the things that I share with at the end of this book is there's a strategy called the controlled compounding strategy, which is a fancy way of saying you can save and use your money at the same time. We're going to go through that today. It's the idea of borrowing. But then I talk about a master account, and a master account is a special type of insurance contract. Now, Chris, you and I both have kind of a love-hate relationship anytime we say life insurance, because we know that a lot of people are super negative about life insurance, and rightfully so. There's a lot of people out there that are out there just to make big commissions and aren't structuring policies right, aren't working with the right companies. And we're going to kind of, you know, expose those people. And this is for the engineers. This is going to be very number heavy. But for me, that's what I needed to understand before I took a jump. And I believe so much in this that I'm dedicating my life to sharing the truth about how these things work. Not because I love life insurance, because I love the results that people are getting by using these contracts.
Yeah, man. All right. So let's do this, Caleb. Let's get into, let's just call out the elephant in the room first, right? And confirm that Dave Ramsey's right. You know, his belief or perception, or I don't know, maybe it's how he thinks every whole life policy is utilized or constructed. But go through and kind of walk through what it looks like, how it's designed, lack of liquidity, the benefits of it even, because
Yeah.
it's not all bad.
Let's talk about the benefits first. The benefits really are that you get a permanent death benefit. And the way that a lot of people are selling this is, you know, Mr. Client, you could buy term insurance, but less than 2% of term insurance pays. So you're essentially throwing this money down the drain. What if you saved in a place, or what if you contributed premium to a place that you get a permanent death benefit someday in the future? And oh, by the way, some of your money's going to grow. And in retirement, it works just fine. The problem is, if you want to use your policy early on, like you and I tell people how to maximize the efficiency of every dollar, you're going to see that. And I don't even have the death benefit in this column. We're just focusing on the cash value, because both you and I, we talk about life insurance, and the life insurance benefit or death benefit's very important, but that's not why we do what we do.
Right.
And you can see the first 2 years, the cash value is zero. Chris, in other words, you pay $20,000 for your permanent life insurance. You get a life insurance benefit,
right?
But your cash value is zero year one. And in year two, it's zero again. And then starting in year three, that's when you're starting to get some cash value. And that's a cash value that, again, it's going to continue to grow. You can borrow against it. Right. The two big problems with these plans is, number one, it takes forever to build up enough cash value to use compared to what other systems that we use. And then the other two is the flexibility of the premium. You're on the hook to pay $20,000 every year until you do what's called a reduced paid up.
Right.
And so those are the two kind of big areas for those engineers in the room. This column's what's called the internal rate of return. And it's after the true cost of all insurance, commissions, like the true growth. And you can see that it breaks even in year 13. And at year 15, the internal rate of return, the true growth is just under 1%, which is, again, is a tax-free. And if you compare it to a savings account, it could outperform in 15 years. That's a long time for a plan to kick in.
Well, yeah, I mean, it's no wonder, you know, I hate to go back to it, but Dave Ramsey, I mean, in year three in this, you got 60,000 into it, but $14,000 of liquidity. And so that's not a recipe for success for a lot of people. You know, if they're and I think, just to kind of pivot a little bit, it's when you look at this, if you're comparing this to an investment, you know, then that's obviously hugely negative, right? And so really having clarity around that, it looks like, yeah, year 13 is ultimately when you're kind of break even. But I'm going to even argue and say that's not even break even yet when you take inflation and everything else into consideration. That, you know, it obviously is not ideal, right? So okay, so I think we can agree that Dave Ramsey's right. Whole life insurance stinks in that capacity. You know, there are certainly benefits, but for the average American family, that isn't the solution that they're looking for.
Right.
That's not the solution that's going to serve them the best.
Right. Yeah, I wholeheartedly agree. And I think the sad reality is many people just don't know they don't know this stuff, and they go to a trusted advisor, and it's not like the advisor's doing a terrible thing, but knowing what we know, I know for a fact that we can structure these things as an asset and as more as a savings vehicle. I'll note one other thing, Chris. We talk a lot about life insurance not as an investment. You know, life insurance is not an investment. A lot of people sell it like an investment, and the reality is it can outperform many investments if you look at the tax benefits. And we could go into how they have income and access to, but from a regulatory, or just from simply like how I see life insurance, I do not sell it as an investment. I sell it as a savings alternative. And when you do that, then you all have to ask the question, what other savings vehicles out there can do these kind of things? And I'll be completely frank, in the first couple of years, savings account way outperforms, a whole life insurance contract. You have to have this for over 20 some years for this to start making sense. And that's kind of my big dilemma. And that's where, when Dave Ramsey is helping people and kind of calling agents out, he's absolutely right. A lot of people are designing these plans where it takes forever, and they're killing flexibility, and the uses of their dollar could be better spent.
Yep, I agree. All right, so let's move forward and talk about some good stuff.
Yeah, so I'm going to give us 3 typical designs of whole life banking plan. So if you've read a book by like Nelson Nash or by Pamela Yellen, Bank on Yourself, and there's a lot of other people that have written books like the one that I wrote, and their whole philosophy is this: put your money in a place that's going to grow the rest of your life and have the ability to borrow against that money to use to do things like invest in your business, in real estate, maybe it's to pay off debt, but your money is continuing to grow. The reason I called my book The And Asset is you can do both instead of just one thing. So when we're looking at these contracts, we have to have a long-term mindset, because when you pay cash, or when you don't have the system, every decision you make, when you spend cash on a car, and we're going to go into a car example later on, you're not just killing that growth, you're killing what that dollar could have grown the rest of your life. So the benefit of this is a long-term growth, but the cool thing that you'll see is you can actually use this cash value early on, but your money's continuing to grow. And one of the typical ways that we design this is what's called PUA rider. A PUA rider stands up for paid up insurance. And it's one of the best ways to get as much cash value in as possible to your contract. And the reason why a lot of people shy away from it, Chris, is, as you know, the commission on these things are almost zero. So it cuts our commission by 50, 60, 70%, but it gives the client a lot more flexibility, which is very important to me. And you're able to have cash value growing for you early on. So each year in this plan, you have flexibility. The 20,000 is kind of the target number that we're going for, but you can bring this all the way down to like 7,500. So there's a lot of flexibility, and this represents the cash value that you would have. You can see there's no zeros first year. You actually are building up equity, and this is your death benefit, which again is to the very weird number. And the reason, and you have many videos about this, Chris, but when we overfund, we're reverse engineering the policy and getting the least amount of death benefit we can, to stuff in as much cash as we can.
And this is the key. I actually want to point on this, because I get a lot of negative comments around this, talking about when you take a loan against your policy, or a lot of people say from your policy because they're misinformed. But when you take a loan against your policy, they say, well, that comes off the death benefit, right? And so I think it's key to understand as you look at this, right? You start off with $843,000 in death benefit. Well, just by the sheer nature of it, to make sure it doesn't mech, and for all the paid up additions and everything else that kind of goes into the equation, your death benefit is going up and up and up and up every single year as the cash value increases. So if your death benefit, ultimately, no matter what happens when you take loans from it, your death benefit is never going to be lower than what you initially started with. So that's important to understand. People like Dave Ramsey would pitch this as saying, well, you started off with an $843,000 death benefit in this example. So 10 years from now, you take $383,000 loan against it, you're only going to have a $500,000 death benefit or something of that nature. You know what I mean? And that's nowhere near the case.
Right, because your death benefit's growing so significantly.
Yes.
I mean, if you look at, you're contributing 20,000 in year 2, but your death benefit's increasing by more than 20,000.
Which is another huge advantage against term insurance, right? Because now this is also accounting, it kind of counterbalances inflation, versus if you buy a 20-year term policy and you buy $1 million, 20 years from now, that $1 million policy is really only worth $500,000 of purchasing power in today's market, right? This is going to be worth, you buy $800,000 in life insurance here, and you got 1.8 million in 20 years.
Right.
So.
And another thing that I go into is, okay, does the death benefit matter more today when your chances of dying is the least, or does it matter when you're growing older, when your chance of dying increase more and more, knowing that your death benefit's significantly growing? It's one of those things where we're getting the best of both worlds. We're maximizing what you care most about, cash, but know that the day that you die, your death benefit's going to be the greatest it's ever been.
Okay, and not to beat this horse dead, but when you look at this, the other thing that probably the comment that drives me nuts the most is the concept of self-insurance. Once you need it, right? Once you're retired, once your kids are out of the house, you don't need insurance. And I'd like to say that when you do this properly and you understand the principles behind this, this is not a need-based product. This is a want-based product. You want this. It'll cover your needs in the short term, But once you get to the point where your family's gone, you're retired, you're financially free, your house is paid off, all these other things, you're not going to have any other asset that's going to outperform what this can do for you and the leverage and flexibility 20 years down the road that this can do for you.
Right. Right. You get to put $1 in a place that's going to grow the rest of your life. You can utilize that capital, and it protects your number one asset.
Completely.
You're spot on. The pros to this, and again, you're watching this video because you want to learn the best. The pros of this plan is because of the 30-year PUA rider, you get flexibility for the next 30 years. So for example, if you hit year 4 and there's a tough, maybe something came up and you don't have 20K, you can drop that down, but then you can the next year bump it back up, and in some cases pay more than $20,000. And long term, you're getting your money as this plan gets more and more efficient. You're getting the ability to contribute for the next 30 years into this plan. The downside to this is whenever you put out the PUA rider longer, the cash value earlier on is a little bit less than what it could be. And we're going to look at another example where I put the PUA rider on for 10 years and you get higher cash value. The trade-off though is you can't save $20,000 every year. And you'll see in year 20, you want to put as much money in as you can. So we'll go into the pros and cons of this. Chris, do you want to say anything more?
No, the only thing I would ask here is just kind of looking down. What is the base premium on this before paid up additions? Is it
$7,573?
Okay, so when you say if year 4 came about and you couldn't afford the 20, all you would have to do, you'd have to make sure you could still afford the 75, 73.
Correct. And this gets a little bit technical, but if you have equity in your policy that you could tap into and borrow against to make that, if you're not over leveraged.
Yep. Perfect.
Yep. All right.
Perfect.
So this is definitely the most sexy looking plan when you first look at it. And I'm going to give you the pros and cons of what we call the high yearly cash value. The high yearly cash value, as you can see, you're putting in $20,000, and in the first year, your cash value is over $17,000. It's almost $18,000. And I apologize, Chris. I pasted the cash value in twice for that benefit.
Okay.
But it's one of those things where it's high yearly cash value. In the first 5 years, you can see that it slightly breaks even. But because this product is built with a lot of term riders and kind of resets the dividend, which is another kind of jargon, you can see where it really takes year 8 or 9 to break even. But it gives you a lot of early cash value. So the benefit of this is if you have a need and you're like, okay, I like the idea of the insurance benefit. I understand long-term that my dollar is going to grow, for the rest of my life, but I don't like the idea of like putting $20,000 in and only having access to $12,000. If that's you, this might be a really good scenario because you can see you have a lot more, cash value. The downside to this, and it's really important that we understand this, is instead of the flexibility from 20,000 to 7,700, you have to make this premium payment every single year. Now, we throw around this term called reduced paid up. Reduced paid up is essentially you can get to a point in your contract where you say, okay, I don't want to pay any more premium. I want to just you take my death benefit, make it as small as possible, and no more premium is going to be due, and my policy is going to increase. You can do that after year 7 or 8 in this plan, but obviously there's benefits and not disadvantages to that as well. So the real benefit of high early cash value is you get early cash value that you can utilize immediately, and it's more.
You have like 90% liquidity immediately.
Yes. The disadvantages are long term. The growth is not as good, and there's a lack of flexibility. So if you get short term benefit, think long term disadvantage, and then it's like there's no deals in this business.
Right. Well, it's all actual. This is the thing about life insurance, and there's life insurance, there's annuities, and the way they structure all this stuff, it's all actuarially based. Life insurance companies make small percentage points on huge amounts of money. And these things are designed. There's no games, there's no schemes. I think that's one of the misconceptions a lot of people have is they think, they're getting ripped off in some capacity.
Right.
But it's just a matter of, you may be being ripped off compared to what you think you need or want, and you maybe bought the wrong product, but it's,
Yep.
you know, it's just,
And for the analytical people out there, I want you to write this number down. So at year 15, your internal rate of return, that means your true rate of return after all the cost, like this is like real. It's 1.49%.
Mm-hmm.
In the Ohio National or there's other companies that we work with, like when you do paid up additions rider, your internal rate of return's 3% at year 15.
Double.
So again, which one's better? It depends on what you're looking for.
Right. So with the high early cash value, the way I look at it, and I agree with you that from a long-term planning perspective, if you don't have that urgency or absolute need on the short term to have liquidity of that money, it definitely makes sense because you have the flexibility and all the other benefits that go with it. But if you're somebody who wants to buy a real estate property, and you have a lot of cash sitting in a bank and you're figuring out, and you're tired of, let's just call it as it is, losing money to inflation in your bank account every single year just to keep it safe. This is just going to be just as safe, if not, I believe, more safe than a bank account. And you're going to have all these ancillary benefits, liquidity of the money, it's going to grow. And if you want to use it, I would say if you're going to do this high early cash value, you better have a strategy that you're comfortable with, that you know of, whether it's leveraging it for your own business, leveraging it for a real estate investment, leveraging it for something that's going to make up the difference for what you lose in the internal rate of return compared to the other strategies, the other policy structures.
Right. 100%. Okay. This is an and strategy for sure.
Yep.
And also just, this is another plan that we have with the paid up additions rider. And it's essentially, you're putting $20,000 in for the first 10 years. And then you can see that your base premium or your actual premium is less. It's $5,238.
Yeah.
So each year in the first 10 years, you could drop it down to $5. But you can see your cash value early on is, over 70% liquidity. It's not 90.
No, but 71% liquidity there is pretty good.
And in year 15, your internal rate of return is over 3%. So when we're looking with real estate and when I'm planning with people, it's never a black and white, but we try to figure out, okay, how can we be flexible? Because we don't want to put our clients at risk of having to make a premium payment. How can we utilize our cash value as soon as possible? And how can we put our plan in place that it's efficient when we're using it, and we're also efficient as the death benefit's growing and long-term growth of the cash value. Okay, so any other things that you want to talk about as it relates to the 4 plans?
Talk to me a little bit about who you think these are the best for. Like really, which policy works best for who and what? What do you typically see as people having for desires or needs? Where does each policy fit best, I should say?
That's a great question. Most people are in a place where they want to be able to utilize their cash value, and yet flexibility is really important. And so as an advisor, if I'm working with someone that sees the benefit of this and they're willing to take less than 90% first year cash value, I will go to a paid up additions rider because I know that there's going to be a lot more flexibility long term. And if we kill the flexibility, then I'm going to do smaller premium payments. And the benefit of this strategy is can you not save more money if you have access to it? So most people are better off saving more money in using, the structure where you add paid up riders and the base, because there's a lot more flexibility there. But the people that tend to like the high early cash value are the people that are in like the trading spaces or into real estate. And they they feel very comfortable with the fact that, the flexibility is less important. I can flip $1. The opportunity cost of not having that 20% difference early on is a big cost. And if someone is making 20, 30, 40% on their money, they'll mostly go with the high early cash value because they're able to be more productive with their dollars in those early years.
So it's basically no policy is created equally, right? So
Right.
it really depends on the system in which you plan on implementing behind each policy.
You've got it. You got it.
And that's key to understand for people as you go through this. So talk to me a little bit about as well, and sorry, I should have jumped to this earlier, but when we talk about internal rate of return, not all rates of returns are created equally, right?
Right.
And
right.
so talk to me about some of the tax benefits and all that stuff that come along with these.
If people that are hated on life insurance understood this, I think there would be this could be the most important video that people watch as it relates to life insurance. And when I learned this conversation, that's when I took a step back and said, wow, we need to do something about this. We need to educate more people about this, because the reality is people don't know what they don't know. And so what I'm doing is I put in just a regular plain vanilla 30-year overfunded policy. So there's nothing crazy about this. This is actually the one that we saw second. You're putting $20,000 in for 30 years. This is the cash value that you have,
Yep.
and this is your death benefit. Mm-hmm. And what we do is, if you look at like the true internal rate of return, it's a little over 4%. Sure. And a common response that we get, Chris, is, wow, 4%, that's not that great. Like, you and I don't get super excited about 4%. Like, right. It's better than a savings account.
It's better than a bond at this point in time. But aside from that, I mean, there's really.
Right. It's not super sexy. Yeah. But we have to ask the question, compared to what, and the person that actually put on this calculator system trained me quite well. His name's Todd Langford. And he always got us to think outside of what we normally go through. And he's like, okay, what are we comparing this to? This is not an investment. This is an and asset or a savings alternative. And so what kind of things that do life insurance have that a savings account doesn't? And the first thing that I want to just look at is, let's look at the opportunity cost of saving your money in a savings account. Mm-hmm. Early on, you have more money in your savings account and more liquidity. But you look over 30 years, if you put your money in a savings account that earns 0 interest, that's over $500,000 difference over 30 years. Mm-hmm. Just about where your money is stored. We're not looking at what you're using it for. We're just looking at the lack of efficiency in some accounts. Now, when people think of 4%, Chris, when you structure and utilize a life insurance contract properly, that 4% is actually tax-free, meaning you don't have to pay taxes on any of the interest, and you can utilize that capital after the rest of your life without ever paying taxes. And this is where it gets really good, because what's taxes going to be in the future?
Right. They're going.
Yeah. I mean, you look at where our country is at. If you are sitting in your chair watching this video and you think taxes are not going up, we might have to make a couple more videos on just like looking at where our country's at, looking at where Social Security's at, where our debt's at, and looking at our historically low taxes. Well,
absolutely. I mean, that's one of my biggest challenges. Everybody talks about putting money into tax deferred accounts, and my comment to them, and this isn't applicable to everybody, but it's applicable to most people. And it's just, first and foremost, where do you think the tax environment's going? Do you think it's going up or down? I mean, the reality is the country's $21 trillion in debt, and interest rates are at all-time lows. They're going to go up. How do you think they're going to pay for that debt? They're going to have to raise the tax base and raise revenue to pay for the debt. That's just, there's no way around that. That's just So if you don't think taxes are going to go up eventually, some way, somehow, you might want to take a good hard look in the mirror. Right. Second, when do you think you're going to make more income now or more income later? Most people, as they go through their career, they make more money. Thirdly, do you think right now you have more tax deductions now or more tax deductions later? You probably own a house, which you hope to pay off. You have a mortgage interest deduction. You probably have kids. Those are deductible, right? Like all these things that you can deduct in life right now that you're not going to be able to deduct later. So a lot of people try to get you to put money into like 401k or other tax deferred accounts, but it's key to understand that when you defer taxes, you're not avoiding taxes. You don't avoid taxes. You have to pay the taxes. It's growing in a tax deferred account that you have to draw out as earned income later. And therefore, if you're pulling it out later when you don't have all these deductions, and ultimately, let's face it, when you retire, everybody says, you want to retire with less or whatever, but realistically, nobody wants to do that. Nobody does. And so it's kind of one of those things where, why not just pay the taxes that you're going to have to pay and be efficient? I don't look at tax efficiency from a year-to-year perspective. I look at it from a lifetime perspective. And how do you optimize your tax efficiency from a career perspective, not on my tax return this year?
100%. I love the rant.
Sorry.
I love it. No, I love it. So so walk with me through this idea. Yeah. I'll start with different income taxes. So let's just say you have someone that doesn't believe taxes are going up. They're not even in the highest tax bracket. Let's just look at a 25% tax. Remember, what are we comparing this account to? This is not an investment. We're comparing it to really a savings alternative.
A banking alternative.
You have access to this capital, but your money's going to continue to grow. That if people understood that one thing, this would be 10 times more attractive than just an life insurance policy.
But I'm going to jump in and play devil's advocate for you real quick, because I just want to hear you answer this question. It's not a bank account. It's a life insurance account, right? Mm-hmm. Contract. How hard is it to have access to my money? That's a great question. A bank account, you can go to the bank the same day and get your money. Mm-hmm. This, you can get your money within a week. Okay. So it's not, that's really glad that you asked that. It's not like you get a debit card that you can use this money, but you at least have a week to 2 weeks access to this money, and it can be put right in your bank account. And there's no, it's easy to get from like you don't need to apply or get anyone to get your stamp of approval, but it's It's a simple form. Or if you work with a company like ours, we work with our clients and call the companies on their behalf and do all the work for them. Okay, perfect. I just thought it was important that people understood that. So. Right, totally. Good. So right now, Chris, what accounts today, because remember, these are all illustrations on today's environment, not in the 80s. What account could you put your money in a place that grows more than 5% every single year without a down year and still maintain access to this capital? Well, you just threw in the caveat there is without a down year. So, I mean, now we're starting to compete with some investments. Sure. And this is 25%. If you're sitting in California and successful and have a lot of money, and you're paying 50%, obviously, talk to your tax person. Taxes could go up, they could go down, but I'm showing this for illustrative purposes only. The more taxes go up, the more attractive that these plans are, because they're one of the only places that you can save your money. It will grow and you can use it all tax exempt if set up and used properly. And so whether it's 30%, if in 30% you need to earn 5.7% every single year without a down year. And now we're looking at different investments. And one of the things that I wrote about in my book is looking at the fees that we're paying. And yes, there's cost in these plans, as you can see, because you're paying for a permanent death benefit, but you're not paying a percentage-based fee for your assets like most people. Most people are saving or investing money, taking risk, and paying a percentage fee on their whole dollar amount. Sure. Yeah. And management fee of 1 or 2% or whatever it winds up being after all the funds that you have it in and the person managing your account and all that stuff. Right. And let's just say you have a management fee of 1%. Now you have to earn over 6.7% every single year. We're competing with a lot of investments, but investments don't grow when you utilize that capital. And we're also giving you the ability to use that capital. And that's why, again, my book is called The And Asset, because we have to understand that this is not an or. It's not like you can do this or do advice from, Robert Kiyosaki or Dave Ramsey, your investment advisor. If you understand how this works, you can do both if you set it up and use it properly. I love it. And one other thing, we talk about term insurance. Term insurance is not bad. It's just, we have to understand that it's a cost and there's an opportunity cost. In other words, when you're throwing money down the drain and hopefully it'll never kick in. When you do permanent whole life insurance and when you set it up properly, in some cases, you might not need life insurance, like a term insurance benefit. You might, but we also have to look at, if you didn't do this, you would have to buy term and invest the difference. We've heard that strategy. You actually have a couple of videos on this as well on your YouTube channel. Yep. So let's include, let's say you're paying $1,000 for a term policy of $1 million. And this is another thing that I'll add is, and you mentioned this early, at the end of 30 years, you have over 2.3 million. Sorry, God.
we're just doing the simple straight line, but how this calculation works is now that we're spending $1,000 on expense, now you only have $19,000 to in that alternative account that needs to work that much harder. And so the point that I'm trying to make is 4% is not crazy. This is not a get rich quick scheme. What this is it's pretty attractive when you understand the tax benefits, you understand that there's no percentage-based fees, when you understand that you have an asset that's growing that might make you more efficient in other areas. And we're not even showing you how to utilize this cash value, but also think about all the opportunities that are going to come up throughout your life when you have access to capital that's safe. And if you compared it to other situations, you have to earn over 7% every single year, which most people aren't even getting close in accounts that are postponing their taxes, they're taking unnecessary risk, and they have no control.
Right. Yeah, no, I mean, it makes all the sense in the world. And if you look at that, just year after year, you're renting insurance, right? I mean, that's really what you're doing. And so every year that money's gone, it's burned. And if you compare apples to apples, I mean, I know the numbers are significantly bigger. Right. But with whole life insurance, you put in $200,000 over 10 years and you have $220,000 of liquidity at the end of it, right? So you're actually, it's not making a ton of money, but you have liquidity of that money the whole time. You're not just burning $20,000 that's going to be gone. I mean, that $20,000, you might as well just light on fire if you don't die, which obviously you hope to not die. Right,
right. And the compound interest works great. It's one of those things that gets better and better over time. Yeah, and this system allows your dollars to compound to the day that you die, not just retirement. And we're only showing you a 30-year time period. Right. But think about it. Some people will have their compounding, and look at me. I might have compound interest work for the next 80 years. That's right. That's super significant.
And talk about legacy, right? When you talk about legacy, and you talk about, you know, all these people who say, well, you don't need insurance. Well, go ahead and show me somewhere where you're going to be able to pass your money on more efficiently. You know, I don't know anybody in the world that wants to just give Uncle Sam and the government, you know, a good portion of their estate when they kick the bucket. You know what I mean? Like, so right. This is the most efficient legacy vehicle that you can pass on, whether it's to your family, to a charity, to, you know, community, or whatever you want to do. It's a no-brainer when you really, really understand it.
Right. And we're not even to the best part yet. So, but the purpose of this video is to share with you that while life insurance is not super aggressive, it has a great growth strategy, and over time it's really actually quite attractive. It's a lot of people try to underplay that, oh, it's like life insurance is not that great a rate of return. It is when you look at all the benefits that it has.
Awesome.
Okay. Now we're going to get into the borrowing example. And what I'm going to do here, and Chris, we can work off of each other, is I'm going to go through an example of you using your savings account, because you can bank with your savings account.
Sure.
And then we're going to go into using a policy and what it would look like. And I think it's going to be really, really helpful for your audience. And this again, for me, was an aha moment, because there's nothing free about what we're doing, but right. when we understand the efficiency of right. decisions, I think people will understand that this is you know, an awesome thing. So what we're going to do is we're going to look at buying cars. Now, what Chris and I are both big proponents on is understanding the difference between a liability and an asset. Mm-hmm. Essentially, an asset is something that's going to put money back in your pocket, where a liability is most likely going to take money from your pocket. And
there's a living expense to it.
That's a good example. And here's the deal. What I'm going to show you works on both. And the disclaimer is no one's going to get rich by buying liabilities. So I'm going to show you, a lot of people get mixed up on, they get all focused on what to purchase. And that's really, really good. Like, that's important. This strategy is not necessarily what you purchase, it's how you go about it. And that's why it's like, whether you buy real estate or whether you buy a liability, the life insurance component is the same, but what you purchase can also increase or decrease where you're going. that mindset alone could just help a lot of people, because I feel like there's a lot of miscommunication as it relates to this strategy and how it works.
So ultimately what you're saying is if what you're going to show works on a liability, imagine how it will work on an asset.
Yeah.
Okay.
Exactly what I'm saying.
Perfect.
All right, Chris, and I'm going to make you take some notes. And so if you're watching this video, take notes. I guarantee you it's going to help. Okay. So what we're doing is over 30 years, we're assuming someone's going to put $20,000 in per year. Now this could be 10,000, this could be 5,000, this could be 100,000. Doesn't matter, for example. And we're also going to assume, well, let's actually bring this up. We're going to assume that you can earn 2% in a savings account. I know we're being super generous.
Oh, you're nice.
But let's just say there's accounts out there that you're going to use, because we're comparing this with banking. You're saving, you have control, you're able to do things. We're going to buy cars, but 2% every year. We're also going to assume that there's a 30% tax bracket. Okay. So the first thing that I want you to note is without taxes, you would have $827,000 at the end of that year. When you add a 30% tax bracket, you have $749,686. So if you're taking notes, write down that number. That's where your money would be at 30 years. And
can I just say 750?
Yes, put 750.
Okay.
You're gonna get some.
I'm gonna keep it. Yeah, I don't have a notepad, so I'm just gonna write it down on my phone here. Here we go.
Okay.
All right, let's do this.
Okay, and now what we're gonna do is we're gonna buy cars. And again, for the analytical person, we're saying the car is gonna cost $50,000. We're buying 5 cars. The first purchase is gonna be in the 4th year, and we're gonna repay ourselves, every 4 years. Okay, so let's just retrack. You're putting your money in a savings account. You hear about this banking strategy and you say, Caleb, I read your book, but I could bank and pay myself back instead of doing your life insurance thing. And you know what? You're absolutely right. You can absolutely, do this with a savings account. I'm going to show you. And this is
ultimately for somebody who likes to pay cash for cars.
Totally.
Okay. Yep.
And so you have $50,000. You're buying 5 cars throughout your life.
Yep. And
you're paying cash, but then you're being an honest banker and you're taking that money and putting it back in your account. Tracking?
Because you're gonna have to, unless you want to finance the next car. Principally speaking, you have to. Yeah,
right. Exactly. And one thing to note is you paid cash for your cars, but there's a difference. Instead of 750, you have 738,000. Okay, why is that? It's because when you took that money out of that account, even though you were earning 2% plus taxes, that money is no longer able to be productive for you. And that's only in a short period of time. But that's an example of you paid cash for something, but it did actually cost you something.
$12,000.
Cost you $12,000. Another way to think about this, and Nelson Nash writes this in his book, Becoming Your Own Banker, is we finance everything that we purchase. I write about this in my book and say every decision we make has a consequence. When you utilize a dollar, that dollar has more than one. It's going to affect your plan more than just one way. Okay. Now, a lot of these insurance companies have loan rates around 5%. Actually, the company that I work with is less than 5%, but I just want to be easy and across the board and use the 5%. And so if you pay yourself back with 5%, mathematically, you should have more money. And in fact, you do. So what's happening here is you're paying $20,000 into your savings account. You're being a banker. You're buying cars with cash. You're paying yourself back at 5%. And you have $778,000 after 30 years plus those 5 cars. Are you tracking?
So now you got 778 instead of 738. So it's $40,000 more.
Right. So an apples to apples comparison is, if you're taking notes, write down 778,000. That's in a savings account, assuming you're in 2%, and also assuming that you're paying yourself back with 5% interest, which no one's doing, but we're gonna go along for it just because that's what we're gonna do.
Okay, sounds good.
All right. So why life insurance? I'm gonna pull in the traditional 30-year paid-up addition rider life insurance plan, and you can see okay, first couple of years, you're better off in a savings account.
Sure.
And I just want you to see, okay, 950,000, it's way ahead of the 778, but
that's 200. Yeah.
But do we pay taxes in a life insurance plan, Chris?
No.
So let's eliminate the taxes, because once that money's in, it's going to grow and you can utilize it tax-free.
Yep.
So that's one. Now it's much better. That tells you why we want to get the taxes out of our life.
Mm-hmm.
It's over 1.1 million. Okay. Now what we're going to do is we're going to do the same car example. And I'm putting in 5% here because the 5% doesn't go to us. It goes to the insurance company. Right. But in return, our money's growing every single year.
Yep.
Without any interruptions. You take, just waiting for you buy 5 cars, and we're not taking it from our cash value. We're actually borrowing against our cash value, which again, why does that matter? It's more efficient when your money's continuing to grow.
Right.
And
yeah.
And so let me ask you this, if you're watching this on YouTube or wherever you're watching this, the one big thing that people get against the strategy is they say, Caleb, I don't like the idea of paying interest. And I showed you the person that paid cash paid interest, because they didn't pay interest, but they paid cash, and so they weren't able to earn interest. But in this example, your money's continuing to grow, you're borrowing against your dollars, and you have to pay a little over $32,000 worth of interest over those 5 years to the insurance company. This is math heavy, but this is your loan, this is your payment, and that this payment is going to the insurance company. So $32,000 of interest for this, but look at your cash value. It's still $1,167,752. That's a lot more.
Almost 400,000 more. That's almost 50% more cash. It's 40-something% more cash.
So Chris, are you okay paying $32,000 worth of interest over the next 20 some years to have over $400,000 more in your account?
I think I could tolerate that.
We're not even adding the death benefit in, which will be very significant.
Sure.
And maybe at a future video, we can share with your audience how we utilize that in retirement. Because if you want to start comparing this to a pension plan or annuity, there's a lot of big benefits of having this later. But we're showing you how to start using your policy to buy your dream car in the first couple of years.
Yeah. Well, that's the amazing part about this, is how you can, I mean, there's, like you said before, though, there's never something for nothing. It's just if you are somebody who's going to be disciplined, if you are somebody who resonates with the idea that you have to have a system, you have to have an element of delayed gratification, and if you just want to do that more effectively and more efficiently, this is the way to do it.
Right. And I want to share with your audience another thing that was very significant for me, because we showed you taking a loan for a liability, which again, it's $400,000 more, but you're not buying a car is never going to put you ahead unless you use it for some ROI positive idea.
Right. Sure.
What if you bought a real estate property and you were confident that you can make 12%? Okay.
Well, yeah.
Remember, your money is never leaving your policy. It's continuing to grow.
Mm-hmm.
You borrow against your policy, and the cost of that is 5%. I write about this in my book. Okay.
Yep.
So the control cost for your money is 5%. Okay. That's going to go in your present value. I'm showing you kind of how we calculate rates of return and how leverage works. And then your investment is going to be 12%. So the person that had paid cash for this investment would make 12%. 1 year, do you want to guess what rate of return that this person, if you were using this plan, would get on that same real estate property? Because they weren't using their money, they were using the insurance company's money while their money was continuing to grow.
Tell me.
140%. If you're someone out there that says, I can get a better rate of return, awesome. This is not or do this or do that. This is learn how to do both. And yes, there's nothing, this is just a simple leverage calculation. But when you're able to do both over a long period of time, that's when you start getting ahead.
Amen, brother. That's awesome.
Yeah.
So this is awesome. I mean, I love this, and I hope ultimately that the goal is accomplished, and there's more clarity, right?
Yep.
So I hope this has given more clarity, answered questions, and what I'd love for this is I'm going to link this video. So if you're watching this now, maybe you came from this, but I'm going to link it up to a lot of the other comments and questions that I had in a lot of my other videos. But if you have any comments and questions about any of this stuff, I'm gonna have Caleb linked up to this. He'll be able to look at it. I'm sure he'll engage. I'll certainly engage, answer anything. If you have any other videos that and specific questions that you want Caleb and I to film to answer for you, let us know and we'll do it and we'll help you out. And my big passion for this is I believe in this so much. That's why Caleb and I partnered up to do this video. And I believe in this so much that I don't want to see people getting taken advantage of, and not necessarily taken advantage of, but I just don't want to see people make bad decisions because of a lack of education on their part and on their agent's part. I don't believe that there are a lot of people, sure there are some, but I don't believe there are a lot of agents out there that are, trying to scam people and take advantage and get them into the wrong product. I just believe there are a lot of agents that don't understand this. And I promise you, if you watch this video all the way till now and you're watching me right at this moment, you understand more about life insurance now than 95% of life insurance agents. So,
and this is one of the first of many videos.
Yeah, totally.
And we're only going to get better. I want to, can I finish with just one?
Yeah, go for it, bro. Example? One last thing. Go for it.
When I talk to people, I'm a big numbers guy, but I don't actually bring up any numbers with people originally when we first talk, because I realize that people don't make decisions off of numbers. We think they do, but they don't. It's what people really want is results. And this really, kind of came alive with me when I just kind of thought of this picture, and I kind of use this in the way that I talk to people, and this might resonate with you. The first thing that I firmly believe is that you are your greatest asset. In other words, Chris, your ability to make videos, start businesses, coach people, add value is your greatest asset. Not an insurance contract, not a real estate deal, not your Jeep. It's and what we're essentially doing is what's your why? What things do you want to see happen? Let's build into you, but let's also protect you, because if something happens to you, whether you get disabled or whether you get killed or whether you get whatever happens, you could, hurt, your legacy could maybe stop, and you're going to do what's the quote that Blanton does? What you want to happen will happen.
Life insurance is the only thing to make sure what you want to happen will happen when you want it to happen, whether you're here to see it or not.
And rewind that video and listen to that again, because it's very, very profound. Now, if you take $1 then and you put it in a place that's going to grow the rest of your life, okay, that's really significant, because remember, we're not just looking at a 30-year time period, we're looking at lifetime compounding. And if that's all we're looking at, and we're showing someone how to take out income, that could be a huge advantage. But we're also showing you how you can utilize your cash value to maybe invest in, a business, in investing. Maybe it's paying off debt. Maybe it's, I'm going to put question marks, because I don't really care what you do with it, as long as you have a reason why you're utilizing your cash. And then that same dollar also is going to go into making sure that what you want to happen will happen, even if something happens to you. And we're taking $1 and giving it at least 3 jobs, and just wait till you understand how this can be used in retirement and how it can be used for maybe other alternative plans. But what we're doing is we're helping you be efficient and giving it 3 jobs instead of 1. And for me, sometimes we can argue about all the numbers and which plan is better than the other.
Yeah.
We have to understand the big picture of where can I save $1 in a place that's going to grow the rest of my life, where I have access to use it throughout my life, and where that same dollar is protecting my number 1 asset, which is my ability to produce.
Love it, man. That's awesome. I hope people get that. So, I think we're going to cut it now. I mean, I know it's gone long. I hope you guys found a lot of value in this. You're probably accustomed to me doing long videos by now. So, but it's awesome. Honestly, it's probably one of the most important pieces of information that if you're looking to buy a policy, one of the most important videos you're ever going to watch. And honestly, my guess is there's a good chance that your life insurance agent that's bounced around on YouTube and watching this right now And so if you have any questions there as well, feel free to reach out. I mean, I know Caleb's happy to talk to you, and we can kind of go from there. So that's
Chris,
it for now, guys. I hope it helps.
It's been a pleasure being on. Thank you.
Yeah, you too, brother. We'll talk to you soon. All right. Take care, pal.